The clock starts ticking the second a big chunk of cash hits your account.
Mm-hmm.
That moment, a huge bonus, an inheritance, maybe you sell a business, it forces you into one of the highest stakes financial decisions you can make.
It really is. It's this raw confrontation between cold, hard math
Right.
and, well, our very human psychology.
It's a fork in the road, isn't it?
Yeah.
And the path you choose right then and there can seriously change the wealth you build over the next, say, 20 years.
It absolutely will. And that's what this deep dive is all about. We're trying to cut through all that noise. We've synthesized decades of investment strategy, everything from the latest robo-advisor reports to the mechanics of ETFs, all the way back to the foundational math of modern portfolio theory.
And our mission here is, I think, pretty simple. We want to give you the most powerful, evidence-based roadmap we can find to handle that huge investment decision.
The goal is to make sure you can overcome those behavioral biases that honestly trip up even the smartest investors all the time.
We've got a great stack of sources for this. Global studies on investment timing, really detailed analyses of the whole automated investment landscape.
And, speaking of clarity and getting actionable insights that really simplify these complex financial ideas, which is the whole reason we're doing this, we need to pause for a second.
Right.
This is crucial. For more of this kind of stuff, you absolutely need to subscribe to Money Mindset. It's the resource that helps clarify these high-impact choices.
And the core conflict today, the tension that you see in all our source material, is exactly that. It's the rational mathematical strategy versus our own fear, our regret, our loss aversion.
The data confirms something pretty amazing, which is that a small number of financial choices determine most long-term outcomes.
And deciding how to deploy a windfall has to be one of the biggest.
It's right at the top of the list. So we need to equip you with the knowledge to make the right choice, even when your gut is screaming at you to do the opposite.
Okay, so let's dig into that high-stakes timing question first. You've got this huge pile of money. What do you do?
Path 1, dump it all in the market immediately. Path 2, you spread it out, you invest it in chunks over, say, the next 3 or 6 months.
Lump sum versus cost averaging. But we need to be really, really precise here about what we mean by these terms in this specific situation.
That precision is everything, because you hear dollar cost averaging thrown around all the time.
Right, for just regular investing.
Exactly. For most people, investing a bit from every paycheck, that's just routine investing. You have to do it to build wealth. What we're talking about here is totally different. It's the deployment of a single, sudden, massive pile of cash that's just sitting there ready to go.
Okay, so lump sum, LS, means you take the whole amount, let's use $100,000 as an example, and invest it the very next day.
Correct. The whole thing. And cost averaging, CA, means you split that same 100 grand into maybe 3 chunks of about $33,000.
And you invest one chunk per month for the next 3 months.
Exactly. And the logic, it feels sound, it feels like a hedge. It reduces the risk of what we call bad timing luck. That nightmare scenario where you invest everything right before a massive market crash.
Oh, the psychological comfort of that is huge. I get it. But this is where the math really comes face to face with our feelings.
It really does. Because the surprising statistical reality, and this is based on extensive historical data going back almost 50 years.
From when to when?
We're looking at 1976 all the way through 2022. The result is just staggering. Immediate action wins.
It just wins.
The immediate action, the lump sum strategy, it outperforms the common cost averaging strategies roughly 2/3 of the time.
Wait, 2/3. What's the specific number from the research?
That specific finding across all that global market index data is that lump sum outperforms 68% of the time.
68%.
Yeah.
That's not a marginal advantage. That's a commanding historical fact.
It is.
So how do we explain that? How can it be so consistent?
It all boils down to one simple foundational truth of long-term investing. It's the principle of maximizing your time in the market.
Time in the market, not timing the market.
Precisely. Think of that capital as a resource. It needs to be put to work immediately. If you delay, you are guaranteeing an opportunity cost. You're choosing to lose out on potential returns.
That just clicks. It
Yeah.
makes perfect sense. If I have a 1-year window for that $100,000 and I invest it all today, that money has 12 full months to grow and compound.
But if you use, say, a 4-month cost averaging strategy,
Right.
then the entire 100,000 is only fully invested for 8 months of that year. In the first month, only 25% is working for you. The second month, only 50%.
And the rest is just sitting there.
It's sitting in cash, maybe earning next to nothing in a money market account. And those months represent the loss of the potential risk premium that the market typically offers over time. This is the simple, powerful reason why compounding requires staying invested over long periods. Holding cash, even for a short while, is a drag on your expected returns.
Can we put some real numbers to that drag?
Mhm.
I think quantifying the opportunity cost would really drive this home.
Absolutely. Let's use that $100,000 initial investment, and we'll use a pretty common moderate portfolio, 60% equities, 40% bonds, and look at it over 1 year.
Okay.
The median wealth difference is pretty substantial. The lump sum strategy at the median outcome turned that 100 grand into about $109,360 after a year.
Okay, so a $9,300 gain. What
Yeah.
about cost averaging?
The 3-month CA strategy yielded $107,453.
So that's a difference of almost $2,000.
$1,907 to be exact, generated just by investing immediately instead of waiting. That's a 1.8% median outperformance for the lump sum approach.
And I'm guessing that gap gets even wider if the portfolio is more aggressive.
It does, significantly. For a 100% equity portfolio, the median 1-year wealth from lump sum was 2.2% higher than cost averaging.
So that confirms it. The more risk you're taking on for that higher expected return, the bigger the penalty you pay for keeping money on the sidelines.
The opportunity cost gets bigger. Exactly.
So the math is just overwhelmingly clear. Invest right away, you've got a 68% chance of a better outcome and a higher median return. And yet, so many investors still choose cost averaging.
And this brings us right back to that core conflict, behavioral psychology.
It's our own brains working against us.
This choice is a perfect example of where behavioral biases reliably lead to poor investment decisions. The psychological driver here is classic loss aversion. We are just hardwired as humans to feel the pain of a loss much more intensely than the pleasure of an equivalent gain.
I can feel that viscerally. If you're sitting on, say, $500,000 from an inheritance and you invested all at once and the market drops 10% next week, the feeling would be psychologically devastating. The regret would be enormous, even if you know intellectually that the drop is temporary.
Exactly. So investors who choose cost averaging, they're sacrificing expected returns. They know the 68% stat, but they're essentially buying an insurance policy.
An insurance policy against what?
Against regret. They are purchasing emotional and psychological comfort. They are willing to accept a statistically lower return to dramatically reduce the chance of feeling that deep regret from investing right at the peak just before a crash.
And your research actually shows that in the absolute worst case scenarios, that insurance policy actually pays off.
It does. This is a critical nuance. When we look at the worst historical outcomes, specifically the bottom 5th percentile of all the scenarios we simulated, the cost averaging strategy does outperform lump sum.
So it doesn't win often, but when it does, it's when things are really, really bad.
Exactly. It's when the market is collapsing. And in those extreme downside scenarios, it does provide some valuable risk mitigation.
Okay, so the trade-off is clear. If you're an investor with really high loss aversion, and you know that seeing a big immediate drop would cause you to panic and sell,
Which is the ultimate investing sin.
then maybe the psychologically safer CA route is justifiable, even if it's suboptimal by the numbers. The best plan is the one you can actually stick with.
That is the definition of a successful long-term financial plan. It's the one you can adhere to. So if your behavioral comfort dictates using cost averaging, the actionable tip here is to minimize that opportunity cost.
Oh.
Keep the averaging period as short as you can stomach. 3 months, not 6 or 12. Shortening that window gets your capital working for you sooner.
And this whole principle of maximizing time in the market, it's not just for windfalls, is it? It applies to our regular investing, too.
Absolutely. The logic that compounding requires staying invested over long periods suggests that investors, especially those with retirement accounts like a 401k or an IRA, should try to front-load their yearly contributions. If you can afford to, make your maximum annual contribution in January instead of spreading it out over 12 months. That small difference of a few extra months of compounding, when you repeat it over 20 or 30 years, becomes an enormous amount of money.
That's a perfect summary of that first big choice. We know what to do with the cash now, so now we need the blueprint, the framework that tells us where to put that cash for the long haul.
And that brings us to section 2, the genius of modern portfolio theory.
So we've established that fighting our own psychology is half the battle. But even the most disciplined person needs a solid mathematical system to follow.
Right.
And back in 1952, a guy named Harry Markowitz published a paper that completely changed how we define risk and laid the groundwork for how trillions of dollars are managed today. We're talking about modern portfolio theory, or MPT.
MPT is the mathematical bedrock of all serious institutional investing. It's what's called mean variance analysis. In plain English, MPT gives us a scientific way to build a portfolio of assets.
So that you maximize your expected return for whatever level of risk you're willing to take.
Exactly. And risk, in this context, is defined specifically as the variance or the volatility of your returns.
Before MPT, people just thought about risk on an asset-by-asset basis, right? Like gold is risky, bonds are safe, a hot tech stock is super risky.
And MPT showed us that was just the wrong way to look at it. It was a revolution in risk assessment. MPT's key insight is what the Nobel laureate James Tobin later called the free lunch of diversification.
The free lunch.
Yes, the risk of any one single asset doesn't matter nearly as much as how that asset behaves relative to the others in your portfolio. You reduce the overall portfolio risk by combining assets that are not perfectly positively correlated.
Okay, so if asset A tends to go up when asset B goes down, they kind of cancel out some of each other's choppiness, even if they're both volatile on their own.
That's it, exactly. As long as the correlation coefficient between two assets is less than 1, meaning they don't move in perfect lockstep, you get a diversification benefit. And that benefit is the free lunch, because you can reduce your risk without having to sacrifice your expected return.
So the magic isn't just in how much an asset bounces around, but in the relationship between the assets.
We call that relationship covariance. The variance of a well-diversified portfolio depends much less on the individual volatility of, say, Apple stock, and much more on its covariance with, say, U.S. Treasury bonds, how those movements interact with each other.
And a classic example is mixing stocks and bonds.
It's the perfect illustration. Equities tend to do well when the economy is expanding, while long-term government bonds often do well during a crisis or a deflationary scare. They have a low or sometimes even negative correlation, which really dampens the whole portfolio's volatility.
So if the goal is to get rid of risk, MPT forces us to see that not all risk is the same. You have to break it down.
Right. Total risk gets split into two parts: specific risk and systematic risk.
Okay, what's specific risk?
Specific risk is also called idiosyncratic or diversifiable risk. This is the risk that's unique to a single company. Think of a product recall for a drug company, a CEO suddenly resigning, a factory having a fire.
And because those events are random and uncorrelated across thousands of different companies, an investor can basically make that risk disappear just by owning a big basket of different stocks.
Precisely. And because rational investors can get rid of specific risk for free through diversification, the market offers no compensation, no extra expected return for taking it on. If you only own one stock and it gets hit by a scandal, well, the market doesn't feel sorry for you.
So the only risk that's left, the only one that actually earns you a reward, is the other type, systematic risk.
That's the one. That's the risk you can't diversify away. Systematic risk or market risk is common to all securities because it's driven by huge macro factors.
Like what?
Inflation shocks, big changes in interest rates, geopolitical instability, global recessions, things that affect everyone.
And this is the risk we just have to live with if we want to earn the market's return.
We have to endure it, yes. The market only rewards investors for bearing systematic risk. And this, crucially, ties right back to the timing dilemma we started with. Because these systematic risks are tied to these complex, unpredictable global factors.
The market movements they cause are impossible to predict.
Fundamentally impossible, which means that MPT, our most rigorous mathematical framework, reinforces the behavioral lesson that market cycles are unpredictable in both timing and direction.
So you shouldn't try to time them. You should just build a portfolio that can weather them.
That is the core mandate MPT gives us, and it also gives us the mathematical solution for doing it. By plotting all the possible combinations of risky assets on a graph of risk versus return, MPT shows us the optimal combinations.
And that's the famous efficient frontier.
Exactly. Imagine a graph. Horizontal axis is risk, vertical is return. The efficient frontier is this curve up in the top left corner. Any portfolio below that curve is suboptimal.
Meaning you could get a better return for the same risk or the same return for less risk.
Right. The portfolios on the curve are all optimal. Where you choose to be on that curve just depends on your personal preference for risk.
And for the most conservative investor who wants the absolute lowest volatility possible.
They would aim for a specific point on that curve known as the Global Minimum Variance Portfolio, GMVP. It's the portfolio of risky assets that has the lowest possible risk.
But in practice, it's a bit more complex.
In practice, we combine these risky portfolios with a risk-free asset, like short-term treasury bills. And when you do that, the efficient set actually changes from a curve into a straight line called the capital allocation line.
It sounds like it complicates things, but I feel like it actually simplifies the job for the average person.
It does, dramatically. The real elegance comes from what we call the two mutual fund theorem. It proves that once you know where that efficient frontier is, any portfolio on it can be perfectly replicated by just holding a mix of two different highly efficient funds.
So instead of me having to analyze thousands of stocks and bonds, if I just know my risk tolerance, I just need to blend two scientifically optimized funds in the right ratio.
Precisely. It takes this infinitely complex universe of investment choices and boils it down to a single decision. What's your personal mix of the risk-free asset and one single, optimal, risky portfolio?
The theory is beautiful, but trying to do all that math and execution yourself is impossible for most people.
It's incredibly daunting.
So the rise of modern investing is really the story of how technology took this complex math and automated it for millions of people.
And that bridge takes us right into the modern world of robo-advisors and ETFs.
That jump from complex academic theory to an actual product you can buy is fascinating. People often call the robo-advisor the offspring of the marriage between modern portfolio theory and advanced computing power.
It's a perfect description. They exist to take those optimized portfolios that MPT defines and just implement them passively, automatically, and this is key, at an extremely low cost.
And the engine that makes this whole thing possible is the Exchange Traded Fund, or ETF.
Right. Robo-advisors are built on ETFs because they are the single most efficient tool for achieving that broad MPT-style diversification. And we can't overstate this point. Automation reduces the number of decisions vulnerable to human error.
Okay, let's drill down on the ETF itself. Everyone knows what a stock is. Most people get mutual funds. What makes an ETF fundamentally different? And why is it so much better for this automated advice model?
An ETF is basically a fund that holds a basket of assets, stocks, bonds, whatever, and divides that ownership into shares. The key mechanical difference from a traditional mutual fund is when it trades.
Mutual funds only trade once a day.
Right. At the end of the day, at the closing net asset value, or NAV, ETF shares, on the other hand, trade on stock exchanges all day long, just like a share of Apple or Microsoft.
That liquidity is nice, but the real power is the cost, right? It's about maximizing that long-term growth.
Absolutely. The cost advantage is huge. ETFs generally have much, much lower expense ratios than comparable mutual funds. A big, passive S&P 500 ETF might charge you an annual fee of just 0.03%.
That's practically free.
It's incredibly cheap.
Yeah.
And they can do that because they have lower marketing, distribution, and accounting costs. If you want to maximize long-term compounding, minimizing the drag from fees is one of the most important things you can do.
And then there's the tax efficiency, which, especially in the U.S., is a massive structural advantage if you're investing in a regular taxable account.
It is an often overlooked secret weapon. With a lot of traditional mutual funds, if a bunch of investors want to sell their shares, the fund manager might have to sell some appreciated stocks to raise cash.
Right.
When they do that, they realize capital gains, and those gains get passed on to all the remaining shareholders who then have to pay taxes on them even if they never sold a single share themselves.
That's the dreaded phantom capital gain problem. You get a tax bill even though you didn't do anything.
And the ETF structure cleverly gets around this because of its unique creation and redemption process with so-called authorized participants, or APs.
And they are the key to this whole thing.
They are. When an investor sells ETF shares on the market, the APs can step in. They exchange huge blocks of ETF shares directly with the fund for a basket of the actual underlying stocks. And because this exchange is done in kind as securities, not cash, it typically doesn't trigger a capital gains tax event for the fund.
So capital gains in an ETF are usually only realized when I, the investor, actually sell my own shares for a profit.
That's the bottom line. It gives you much more control over your tax bill.
And that creation-redemption mechanism is also what keeps the whole thing efficient, right?
It is. The APs have a huge incentive. Arbitrage. If the ETF's share price on the market starts to drift way below the actual value of the stocks it holds, the NAV, the APs will jump in, buy the cheap ETF shares on the market, and immediately trade them to the fund for the more valuable basket of stocks, pocketing the difference.
Their own self-interest keeps the price honest.
Exactly. This constant arbitrage by APs keeps the market price of the ETF tightly aligned with its net asset value. It enforces market efficiency.
So we have this super efficient vehicle. Now let's look at the automation that manages it. The robo-advisor's first job is to match you with the right MPT-driven portfolio.
And the good ones go way beyond just asking you how you feel about risk. They try to measure your risk capacity, your actual ability to take on risk based on your goals, your time horizon, your income.
They use detailed questionnaires.
Right. A platform like Schwab, for instance, will use a pretty extensive questionnaire to place you into one of 12 different risk levels. It's a much more scientific process.
But the automation isn't just about the setup. It's about the ongoing maintenance. It's about protecting us from our own bad habits.
It really is. And the two key automated features that do this are rebalancing and tax loss harvesting.
Let's start with rebalancing.
Rebalancing is just necessary MPT maintenance. If you start with a 60-40 stock bond mix and stocks have a great year, your portfolio might drift to 70-30.
Making it riskier than you intended.
Right. The algorithm will automatically sell some of the winners and buy some of the losers to get you back to your 60-40 target. It usually triggers when an asset class drifts by a certain amount, like 5 percentage points. It takes the emotion out of a decision that's very hard for humans to make.
In tax loss harvesting, or TLH, that's where the complexity really ramps up.
It does. TLH is a powerful way to boost your after-tax returns, but it's hard to do manually. Firms like Wealthfront and Betterment have algorithms that scan your taxable accounts every single day,
Looking for what?
looking for losses. If an investment has dropped in value, the algorithm sells it to realize that capital loss. That loss can then be used to offset other capital gains in your portfolio, lowering your tax bill for the year.
But then you're out of the market.
But only for a split second. The algorithm immediately reinvests the money into a highly similar but not identical security. This keeps your portfolio's risk profile the same and keeps your money working.
And it has to be not identical because of the IRS wash sale rule.
Exactly. The wash sale rule says you can't claim a loss if you buy a substantially identical security within 30 days. An algorithm can track all of this across your entire portfolio far better than a person ever could, maximizing the tax benefit while ensuring that compounding requires staying invested over long periods.
Okay, so this sophisticated automation portfolio construction, rebalancing, TLH, it all comes at a price. How is the market pricing this advice?
We've seen a clear split into two models, digital only and hybrid,
Digital only is the cheapest.
by far. Vanguard's digital advisor is around 0.20% a year. Betterment is about 0.25%. These are incredibly competitive fees for what you're getting.
And then the hybrid models add a human element.
Right. They mix the digital platform with access to a human financial advisor, so they charge a bit more. Vanguard's personal advisor services is around 0.30% annually, but some platforms are getting creative.
Like a Betterment.
Yeah, Betterment lets you pay a flat hourly rate, something like $399, to talk to a certified financial planner for a specific one-off event, getting married, planning for college, without having to upgrade to their permanent, higher-fee premium plan.
This all sounds almost perfect. Low cost, automated, tax-efficient, MPT optimized. But the sources you pulled highlight a pretty big controversy.
Yes.
It proves that even when we outsource the decision, we still have to pay attention to the incentives. We have to talk about cash drag and the Schwab Intelligent Portfolios model.
This is a textbook case of where financial structure and a company's incentives can work directly against the investor's best interest. Schwab Intelligent Portfolios, or SIP, is famous for charging no advisory fee, 0%.
Which sounds amazing.
It sounds incredible. But the catch is that SIP keeps an unusually high amount of cash in its client portfolios.
How high are we talking?
At the time of the review, the average cash allocation in a SIP portfolio was 13%.
13. And what's the industry average?
For a similar moderate risk portfolio, the average is around 7%. For some target date funds, it might be as low as 3%. So 13% is a huge buffer.
Now, we did say cash can be a psychological safeguard. Did that buffer help during bad times?
In the very short term, yes. During the 2022 bear market, Schwab's portfolios lost about 1 percentage point less than the category average. It provided that emotional comfort.
But what's the long-term cost of that comfort?
It's enormous. That cash allocation is a constant drag on your returns because it's not participating in the market's growth. It's not earning that risk premium.
So what did that drag look like over a longer period?
Over the 5-year period that was examined, the Schwab portfolio lagged its category average by 1.9 percentage points per year.
Wow, per year.
That is a massive annualized underperformance. It just confirms that a high cash allocation actively fights against the power of long-term compounding.
And the motivation here isn't just some different investment philosophy. It's structural.
The analysis strongly suggests that Schwab is incentivized to do this because they make money by sweeping that customer cash into their own proprietary bank accounts where they earn interest on it.
And this led to regulatory trouble.
It did. It was a potent enough incentive that it led to a $187 million settlement with regulators over their past disclosure practices related to this exact issue. It just underscores a fundamental lesson. When you hand control to an algorithm, you have to verify that the algorithm is designed to maximize your returns, not the platform's profits.
That structural conflict is a perfect lead-in to our last section. Because even with the perfect MPT plan and the most efficient robo-advisor, the modern financial world is still full of traps that require a higher level of competence to navigate. We started this whole conversation by framing it as math versus psychology, and that Schwab example shows that even in the world of automation, that conflict is still there.
It is. The responsibility ultimately is still on the investor to have the competence to choose the right strategy, and this is the hard part, stick to it.
The G20 and the OECD have a framework for this, right?
They do, the INFE Core Competencies Framework, and it highlights things like planning and managing finances and understanding risk and reward. At a bare minimum, every adult needs to grasp basic concepts like their own risk tolerance, their investment horizon, and why diversification works.
But just knowing the definitions isn't enough, is it? The real test comes when the market gets scary, or maybe even when it gets really exciting.
Absolutely not. And we have to just keep hammering this home because decades of financial behavior research have proven it. Behavioral biases reliably lead to poor investment decisions. Our choices are fundamentally warped by emotions, fear, greed, the instinct to follow the herd.
So a competent investor needs a strategy to control those emotional responses.
A proactive strategy, yes. And a lot of those responses are triggered by external noise, the constant drumbeat of financial news, social media hype, slick marketing campaigns. The OECD framework calls this availability bias.
We overweight the information that's easiest to access and most dramatic.
Exactly. A huge run-up in a stock or a new asset class just dominates the headlines, and that leads directly to fear of missing out, FOMO. And that emotional pull can make you completely abandon a rational, long-term plan you built using MPT.
And there's no better recent example of this than the craze around cryptocurrencies after Bitcoin and Ethereum had that massive run between 2019 and 2021.
That performance was so extreme that it created this powerful emotional demand from investors. The source material notes that even mainstream robo-advisors were feeling significant pressure to consider adding crypto exposure to their portfolios.
Which would have been a decision based purely on recent performance.
Which is the definition of performance chasing. It's the exact opposite of rational, long-term portfolio construction, especially when these assets carry such unique and often non-diversifiable risks.
Beyond these behavioral traps, the industry is always creating new, really complex products that require a much higher level of competence to understand. Let's talk about leveraged ETFs, or LETFs.
LETFs are a perfect example of complexity being sold as convenience. They use derivatives and swaps to try and deliver a return that is a multiple, say, 2 or 3 times, or the inverse of the daily performance of an index.
And that word, daily, is the whole trap.
It is the whole trap. Why? Because that daily rebalancing creates a corrosive effect called volatility drag or volatility tax.
Can you walk us through an example?
Sure. Let's say you have a 2x leveraged ETF tracking an index that starts at 100. On day 1, the index goes up 10% to 110. Your 2x ETF goes up 20% to 120. So far, so good.
Okay.
Day 2, the index drops back down by 9.09%, returning to 100 where it started. Your 2x ETF is supposed to drop by twice that, so 18.18%.
So 18.18% of its new higher value of 120.
Exactly, which means it drops by about 21.8 points, from 120 down to 98.2.
So the index is flat back at 100, but the leveraged ETF is down almost 2%.
That's the drag. It's cumulative, and it gets worse the more volatile the index is. The fund manager is forced to rebalance every day, which means they are mathematically forced to buy high after a good day and sell low after a bad day. It's a guaranteed losing proposition over the long term for a buy and hold investor.
So these are not long-term investment vehicles.
They are purely short-term tactical hedging instruments. The volatility drag guarantees that they violate our core principle that compounding requires staying invested over long periods in appropriate non-decaying assets.
And we're even seeing new complexities top up in what should be simple index funds, like the new spot Ethereum ETFs.
That was a huge market event.
But there's a subtle risk an investor needs to understand.
There is. The complexity comes from a condition the SEC put on the approval. The funds are prohibited from staking the underlying ether they hold.
And what does that mean in practical terms?
Staking is part of the proof of stake process, and it generates rewards, kind of like interest. Right now, those rewards are around 3% annually. By not being able to stake the ether, these funds are leaving 3% of potential returns on the table every single year.
Which is a huge amount of money for a big fund.
It's massive. And the source material suggests that the fund issuers will probably have to charge higher fees to their customers to make up for that lost revenue.
So the investor ends up paying for the product's built-in inefficiency. It's another hidden cost, another frictional drag on compounding.
And this isn't just a U.S. issue. You see other complex structures elsewhere, like synthetic ETFs in Europe.
And their risk is different.
Very different. Unlike a physical ETF that owns the actual stocks, a synthetic ETF uses derivatives, usually a swap with a big bank, to get the index return.
So what's the risk there?
Counterparty risk. The fund doesn't own the assets. It owns a contract with a bank that promises to pay the return. If that bank defaults or collapses, the fund could be in serious trouble, even with collateral. It introduces a whole new layer of opaque risk that physical ETFs just don't have.
Which just brings us back to that core lesson.
Yeah.
Competence means recognizing that complexity often just hides risk and cost. So we've covered the decision, the blueprint, the execution, and the traps. Let's try to synthesize this into some final takeaways.
This entire deep dive, it really funnels back to disciplined decision-making. We can boil it all down to two really big overarching principles for long-term financial success.
Principle 1, maximize your time. We saw that right at the beginning with the timing dilemma.
Exactly. When you're faced with that big pile of cash, you should favor the immediate lump sum strategy if you can psychologically handle it. Because we know, based on decades of history, that compounding requires staying invested over long periods.
Any delay, any cash on the sidelines is a guaranteed opportunity cost.
It's actively working against your long-term return.
Okay, and principle 2, use efficiency and automation as your shield.
Your shield against yourself.
Yeah.
Use low-cost, diversified, automated strategies, ideally built with efficient ETFs to cut down on frictional costs like fees and taxes, but more importantly, to mitigate the human errors that we know will undermine your returns over time.
Because automation reduces the number of decisions vulnerable to human error. It handles the rebalancing, the tax loss harvesting, all the things we're likely to mess up.
Precisely.
We said right at the start that a small number of financial choices determine most long-term outcomes. We've walked through a few of them today. LS versus CA, choosing an efficient robo-advisor over a high-cash model.
And you have to realize this efficiency isn't an accident. Think about the ETF structure we talked about, that arbitrage process where the authorized participants are constantly buying and selling to keep the price aligned with the real value.
The market itself has a built-in mechanism to enforce efficiency.
It does. It has a self-correcting mechanism against misalignment. It ensures that prices eventually reflect rational underlying value.
So your biggest challenge isn't finding the next hot stock. It's enforcing your own disciplined financial plan against your own very human, very predictable tendency toward emotional, high-cost, short-term decisions.
So if the market have an external arbitrage mechanism to correct its own inefficiency, here's the final thought. What is your personal arbitrage mechanism? What is the rule, the system, the automation, the discipline that corrects your inevitable human tendency toward error? That's something you need to actively define and enforce as you build your own efficient frontier.